5 car brands Americans love are collapsing, all at the same time. One brand's stock crashed 57% in a day. One killed the EV it bet its future on. One is selling its headquarters to survive. One fired a fifth of its workforce overnight. And one, who swore it'd beat Tesla, just gave up. This isn't a slowdown, it's a collapse, and it's happening in 2026. Nobody in the industry wants to admit it. The EV bubble just popped. Sales cratered 27% in one quarter. Automakers have already burned tens of billions of dollars that are never coming back. 5 brands, 5 ways to fail. Let's get into it. Lucid Motors, the stock crash that shocked Wall Street. Let's start with the one that made headlines everywhere. Lucid Motors. If you don't know Lucid, here's the quick version. Lucid was supposed to be the luxury EV brand that finally beat Tesla at its own game. Gorgeous design, insane range, a former Tesla chief engineer running the show. Their cars were so good on paper that Lucid's own CEO once said the EV industry would come down to a 2-horse race. Tesla and Lucid. That was the dream. Here's the reality. On July 14th, 2026, Lucid stock did something almost no major automaker stock has ever done. It crashed 57% in a single day. In hours, the company lost more than half its value on a rumor that its board was quietly considering bankruptcy protection. Now, Lucid came out and called the report false. And technically, they're still standing. But here's what makes this story so wild. Even after a furious denial, even after the stock clawed back some of that loss, the damage was done. Because Wall Street didn't panic over nothing. They panicked because the numbers underneath were already terrifying. Lucid lost about $2.7 billion in 2025 alone. That's not revenue. That's pure loss. They've been burning through roughly $1 billion every single quarter just to keep the lights on. In one recent quarter, they built 5,500 vehicles, but only found buyers for a little over 3,000 of them. That means thousands of unsold luxury EVs are just sitting there, piling up in inventory, costing the company money every single day they don't sell. Think about that for a second. This is a company that builds some of the most advanced electric vehicles on the planet, and they still can't find enough buyers to move the cars off the lot. So what did Lucid do? They laid off 12% of their workforce back in February. That wasn't enough. In June, under a brand new CEO, they cut another 18% of their U.S. staff. They eliminated an entire production shift at their Arizona factory. They suspended their own 2026 production guidance because they couldn't even predict how many cars they'd be able to sell. And here's the part that should really make you pause. Lucid isn't some scrappy startup running on fumes. It's backed by Saudi Arabia's Public Investment Fund, one of the richest sovereign wealth funds on Earth. That fund has poured more than $9 billion into Lucid since 2018. $9 billion. And after all that money, after all that engineering talent, after all those beautiful cars, the entire company was valued at just over $2 billion before that stock crash. That's a staggering collapse in value for a company that once had Wall Street convinced it would be the next Tesla. Lucid's last hope is a smaller, cheaper SUV they're racing to launch. If it flops, we may be watching the slow-motion end of one of the most hyped EV brands in American history. Rivian, running out of road. Next up, the brand that was supposed to own the electric truck and SUV market before Ford or GM even had a chance to react. Rivian. Rivian burst onto the scene with the R1T pickup and the R1S SUV. And for a moment, it felt like the second coming of Tesla. Amazon backed them. They had a stock price that made early investors rich on paper. They looked unstoppable. But building electric trucks is brutally expensive, and Rivian has been losing money on nearly every vehicle it makes. To cut costs, the company actually shut down its own assembly line for weeks. Not because of a strike, not because of a supply shortage, but on purpose, just to retool the factory and try to claw back some profitability. Now Rivian is pinning its entire survival on one vehicle, the R2, a smaller, cheaper SUV starting around $45,000. That's the plan. Build something more affordable, hope the mass market finally shows up, and hope it happens fast enough to matter. Here's the problem. Rivian is trying to launch its make-or-break vehicle at the exact moment the federal EV tax credit disappeared, gas prices spiked, and American buyers pulled back from EVs across the board. It's like trying to open a lemonade stand in the middle of a blizzard. The timing could not be worse. Rivian and Lucid are now the only two EV startups from that original wave of hype, the SPAC boom of 2020 and 2021, that are still standing in any meaningful way. Everyone else from that era is already gone. Which brings us to the next part of this story. The EV startup graveyard is full. Before we go further, you need to understand just how many EV brands have already died, because it puts everything else in this video into perspective. Lordstown Motors, an electric pickup startup that went public with huge promises, filed for bankruptcy in 2023. Fisker, founded by legendary designer Henrik Fisker, collapsed in 2024 after burning through hundreds of millions of dollars on a single SUV that buyers just weren't showing up for. Canoo and Nikola, two more heavily hyped EV startups, both filed for bankruptcy in 2025. Proterra, electric last mile, arrival, gone, gone, gone. We're talking about more than 20 major EV startups that have either failed outright or fallen into severe financial distress since 2020. That is not a couple of unlucky companies. That is an entire industry graveyard. And it's not just American startups. Over in China, where EV competition is even more brutal, analysts expect around 50 loss-making EV manufacturers to either restructure or shut down completely as government subsidies dry up and demand slows for the first time in years. 50 companies in one country facing collapse at the same time. This is the part that should really register with you. The EV bubble wasn't just a Tesla story or a Ford story. It was a global gold rush, and the gold rush is over. The survivors left standing are the ones with the deepest pockets. And even they are struggling, which takes us to a name you already know extremely well. Ford. The retreat. Nobody expected. Ford was one of the biggest, boldest bets on the EV future out of any legacy automaker. Remember the F-150 Lightning? The electric version of America's best-selling vehicle for 4 decades straight. Ford bet the farm on it. For a while, it looked like it might actually work. Reservations poured in. Ford bragged about having 200,000 people on the wait list. But the excitement didn't survive contact with reality. Ford was reportedly losing tens of thousands of dollars on every single EV it sold. Their electric vehicle division posted operating losses in the billions, quarter after quarter after quarter. Dealers were sitting on unsold Lightnings and Mustang Mach-E's, watching them collect dust in their lots, while Ford kept pushing more inventory their way. So what happened? Ford pulled the plug. They officially ended production of the F-150 Lightning, the truck that was supposed to prove electric pickups could go mainstream in America. Done, canceled, and it's not just the Lightning. Ford has slashed billions of dollars in planned EV spending, scaled back battery plant investments, and delayed other electric projects that were once treated as untouchable. Here's what makes this so painful for Ford specifically. This is the same company whose gas-powered trucks and SUVs are still their bread and butter, still their biggest moneymakers. They poured billions into chasing an electric future, and in the meantime, the vehicles that actually pay the bills got starved of attention. It's like spending your life savings chasing a trend, while the business that actually works sits right there, ignored. Ford's CEO has publicly said he wants people to think of the company's EV division like a scrappy startup, not judged by traditional profit expectations. When the CEO of a 120-year-old American car company starts talking like that, you know something has gone seriously wrong behind the scenes. Honda and Nissan, the Japanese retreat. Now let's talk about two Japanese giants because their stories might be the most brutal of all. Start with Honda. Honda launched its Zero series of EVs with huge fanfare. This was supposed to be Honda's answer to Tesla, its big swing at the electric future. Executives compared it to a fresh start, a clean sheet of paper, a whole new era for the brand. It didn't survive. Honda quietly canceled its U.S. production plans for the Zero Series. Not scaled down, canceled. That decision came alongside a jaw-dropping $15.7 billion write-off and Honda's first operating loss in 69 years. 69 years. That's how far back you have to go to find a year Honda lost money like this. And here's where the story gets really interesting, because back in December of 2024, Honda and Nissan actually tried to save each other. The two companies announced plans for a historic merger, talking about combining under one holding company by 2026 to fight back against Tesla and the wave of cheap Chinese EVs eating their lunch. On paper, it made sense. Two struggling giants joining forces, sharing the massive cost of building batteries and software instead of bleeding money separately. Some analysts even called it the birth of the third biggest car company on Earth. It fell apart within 2 months. By February of 2025, the deal was dead. Reports say Nissan balked when Honda proposed making Nissan a subsidiary instead of an equal partner. And Nissan just wasn't willing to swallow that kind of demotion. So the partnership collapsed before it ever really started, and both companies walked away right back into the same crisis they were trying to escape together. On top of that failed deal, a new Canadian EV factory got postponed, and a partnership with Sony on EVs got scrapped entirely. One industry analyst put it perfectly: Honda's only real move in the EV space for the last 3 decades has been retreat. Launch a low-volume electric car, sell it in as few places as possible, then quietly cancel it when the numbers don't work. Honda has now done that pattern so many times that experts say the company has never actually built its own long-range EV that stuck around. And then there's Nissan. And honestly, this might be the scariest story in this entire video, made even scarier by the fact that the one lifeline it had, that merger with Honda, is already gone. Nissan just announced plans to lay off around 20,000 employees worldwide. They're closing 7 of their 17 global factories. They're cutting their vehicle lineup nearly in half, from 13 platforms down to 7. They've paused development on future models, including a next-generation Leaf and a new Sentra, because they simply don't have the cash to build everything they promised. And here's the detail that really tells you how serious this is. Nissan put its own Yokohama headquarters, the iconic tower that's been the face of the company for years, up for sale. A building worth an estimated $700 million on the market just to raise cash. When a car company starts selling its own headquarters building, that's not a strategic pivot, that's survival mode. Nissan posted the largest annual loss in its entire history, around $5 billion in a single fiscal year. Their debt levels compared to earnings are nearly double Toyota's and Honda's. And Nissan leaned hard into China, a market that's now flooded with cheaper, faster-moving EV competitors like BYD, leaving Nissan scrambling to catch up in the one country it used to count on for profit. Two of Japan's biggest, proudest car companies, both burned by the same electric gamble, and both left to face it completely alone after their one shot at teaming up fell apart. Remember how we started this video? A stock crashing 57% in a day, a brand killing its most important product, a headquarters up for sale, layoffs stacking on layoffs, a once confident challenger admitting total defeat. Here's the uncomfortable truth connecting every single one of these 5 stories. None of this was really about bad engineering. Lucid builds genuinely impressive cars. Rivian's trucks are engineering marvels. Ford's Lightning was, by most measures, a genuinely good electric truck. This isn't a story about companies that built bad products. This is a story about companies that built their entire business case on something that turned out to be incredibly fragile. Government mandates, tax credits, and a wave of hype that outran actual demand. When the federal EV tax credit expired in September of 2025, it didn't just remove a discount, it ripped the floor out from under the entire industry. U.S. EV sales cratered 27% in a single quarter. Some months saw drops of over 50%. California, the biggest EV market in the country, watched its EV share of new car sales fall from 21% down to under 14% in less than a year. And when the incentives disappeared, something even more revealing happened. Buyers didn't just delay their EV purchase, a lot of them went straight back to hybrids and gas-powered cars instead. Hybrids are surging in popularity right now because they solve the exact anxieties EVs never fully solved. No charging wait, no range panic, no six-figure repair bill if something goes wrong with the battery pack. That's the real lesson buried underneath every collapse in this video. You cannot build a car industry on subsidies and hype alone. Eventually, real customers have to want to buy the car with their own money at a real price without the government sweetening the deal. And right now, in 2026, that number of real willing buyers is a lot smaller than Wall Street bet on. So here's the big question. Is the EV dream completely dead? No, not even close. Tesla is still selling in huge numbers. Global EV sales are actually projected to hit over 23 million units worldwide this year, driven largely by China and Europe. Battery technology keeps getting better, charging keeps getting faster, and someday EVs might genuinely take over. But the fantasy that every single brand could jump in, build expensive electric vehicles, and watch customers show up automatically, that fantasy is officially over. The EV bubble has burst, and these 5 brands are the ones paying the price for believing in it a little too hard, a little too fast. So there you have it. 5 major car brands, 5 different collapses, and one massive lesson about what happens when an entire industry gets ahead of what customers actually want. Look, we love cars here on this channel. All of them. Gas, hybrid, electric, doesn't matter. We're not here to tell you EVs are bad or that the future isn't electric someday. We're here to give you the real story, the numbers nobody else is willing to say out loud, and let you make up your own mind. That's the whole point of what we do. If you learned something today, or if this changed the way you think about the car you might buy next, do me a favor and hit that like button. It genuinely helps this channel more than you'd think, and it costs you nothing. And if you're not subscribed yet, what are you waiting for? We put out videos just like this one every single week, breaking down what's really happening in the car world. The stuff dealerships and car companies would rather you didn't know. Drop a comment down below and tell me this. Do you think any of these 5 brands can turn things around? Or are we watching the slow death of the EV startup era in real time? I want to know what you think, and I promise I'll be reading through the comments. And if you want to keep going down this rabbit hole, I've got another video linked right here that dives into exactly which car brands might not survive the next few years. And trust me, a couple of the names on that list are going to shock you. Thanks for watching, thanks for being part of this community, and I'll see you in the next one. Stay safe out there and keep loving cars.